In January 2026, something unusual began happening in global financial markets. There was no single crash, no emergency summit, no dramatic announcement from a central bank podium. Instead, the shift appeared quietly, inside currency charts, central bank balance sheets, and vault construction projects that rarely make headlines. To the casual observer, nothing seemed broken. But to institutions that manage trillions, the signals were unmistakable. The global monetary system wasn't collapsing, but it was rebalancing, and the US dollar was no longer the unquestioned center of gravity. For decades, the US dollar has been the world's dominant reserve currency, trade settlement unit, and safe haven asset. It has survived wars, recessions, financial crises, and political turmoil. Because of that history, many assume its dominance is permanent. But history doesn't work that way. Reserve currencies don't vanish overnight. They weaken slowly, structurally, often while still appearing strong on the surface. And what makes 2025 and early 2026 different is not a single data point, but a convergence of verified, measurable trends that point to a system under strain. By the end of January 2026, the dollar index, DXY, had fallen to approximately 96, a level not seen since 2022. Many headlines initially described this as a 4-month low, but verified data from Bloomberg, CNBC, and Trading Economics confirmed something more significant. This was a 4-year low. More importantly, it followed a 9 to 10% decline in 2025, marking the worst annual performance for the dollar since 2017. This wasn't a one-off fluctuation. It was the first back-to-back annual decline since 2006 to 2007. That distinction matters. A 4-month dip is noise. A 4-year low after the worst annual performance in nearly a decade is a trend, not a terminal collapse, but a signal that confidence is shifting. And currencies, at their core, are confidence instruments. To understand why this matters, we need to move beyond dramatic predictions and focus on behavior, specifically what governments, central banks, and institutions are actually doing, not what social media claims they might do in the future. One of the least discussed but most revealing developments occurred in late January 2026, when the New York Federal Reserve conducted what are known as rate checks. On the surface, this sounds technical and harmless. In practice, rate checks are often interpreted by markets as a precursor to potential currency intervention. Within hours, speculation spread that the United States and Japan might be coordinating to support the Japanese yen, which had been under sustained pressure. This matters because currency coordination between major economies is rare, and when it happens, it signals that market forces alone are no longer producing acceptable outcomes. According to reporting from Reuters, Bloomberg, and CNBC, traders interpreted the rate checks as a sign that policymakers were at least considering intervention. The result was immediate. The US dollar weakened further, pushing it toward those 4-year lows. Officials, including Treasury Secretary Scott Bessent, denied any confirmed intervention plans. But in currency markets, perception often matters as much as policy. The mere possibility that the United States might coordinate with Japan to manage exchange rates was enough to move billions of dollars. When the world's largest economies begin signaling discomfort with currency volatility, it suggests that the existing system is under stress, not breaking, but bending. At the same time, another asset was sending an even clearer message. Gold did not simply rise in price in January 2026. It delivered its strongest monthly performance since the 1980s, gaining more than 25% in a single month. By January 28 to 29, 2026, gold was trading between $5,268 and $5,344 per ounce. This was not driven by retail speculation or fringe predictions. It was accompanied by rapid upward revisions from the most conservative institutions in global finance. UBS raised its gold forecast to $6,200 for Q1, Q3 2026. Goldman Sachs increased its target to $5,400, up from $4,900. Bank of America projected $6,000 by spring 2026. These institutions are not known for sensationalism. They revise forecasts cautiously, often lagging reality rather than anticipating it. When all three adjust upward within weeks, it signals something deeper than momentum trading. But price alone doesn't tell the full story. Demand does. According to verified data from the World Gold Council, total global gold demand in 2025 exceeded 5,000 metric tons for the first time in recorded history when including over-the-counter transactions. This wasn't just investment demand chasing higher prices. Exchange-traded funds added 801 tons. Bar and coin purchases reached 1,375 tons, the highest level in 12 years. Central banks added 863 tons, slightly below the record levels of 2022 to 2023, but still historically elevated. This distinction matters because it shows that gold prices are being driven by physical accumulation, not paper leverage. Real metal is leaving the market and going into vaults, often domestic vaults. One of the most striking examples comes from Poland. A NATO member, a close U.S. ally, and a frontline state bordering Russia, Poland has quietly become the largest gold buyer in the world over 2024 to 2025. In 2018, Poland held just 103 tons of gold. By 2025, that figure had grown to over 765 tons. In 2024 alone, Poland added 90 tons, the largest annual increase globally. In the first half of 2025, it added another 67.2 tons. What makes this even more significant is intent. Adam Glapiński, president of the National Bank of Poland, publicly stated that the country aims to hold 20% of its reserves in gold. And Poland is not storing this gold abroad. It has built new high-security vaults domestically and repatriated gold previously held overseas. When a frontline NATO ally chooses to physically secure gold within its own borders, this is not ideological posturing. It is risk management. It reflects a growing preference among central banks for assets they can control directly, without reliance on foreign custodians. This trend is not isolated. By 2025, approximately 68% of central banks stored the majority of their gold domestically, up from 50% in 2020. That shift accelerated after 2022, when financial sanctions demonstrated that access to foreign-held assets could be restricted under geopolitical pressure. In Asia, similar patterns are emerging. The Reserve Bank of India, RBI, purchased 73 tons of gold in 2024, quadrupling its 2023 purchases of 16 tons. By the end of 2024, India's gold reserves reached approximately 876 tons, representing about 11% of total reserves. But the more important move was not the purchase, it was the repatriation. In 2024, the RBI publicly disclosed that it had repatriated gold from overseas storage back to India. Only one other country, Nigeria, made a similar disclosure that year. Repatriation does not change ownership. It changes control. It reflects a desire to hold assets within national jurisdiction, immune to external legal or political risk. Meanwhile, China has been pursuing a different but equally strategic approach. Beyond steadily increasing its official gold reserves, reported at approximately 2,280 tons by the end of 2024, the People's Bank of China has begun offering gold storage services to other central banks in Shanghai. According to reports from the Oregon Group in October 2025, at least one Southeast Asian central bank has expressed interest. For decades, London and New York have quietly served as the nerve centers of the global gold system. They are not just cities where gold is traded, but where it is stored, settled, financed, and legally custodied. Central banks around the world have relied on vaults in the United Kingdom and the United States not simply for convenience, but because these locations sat at the heart of a Western-dominated financial order. Control over gold storage has long translated into influence over liquidity, collateral access, and crisis-time decision-making. That is why China's move is so significant. By offering foreign central banks the option to store gold in Shanghai, the People's Bank of China is not merely accumulating metal, it is constructing parallel financial infrastructure. This reduces reliance on Western custody systems and introduces an alternative center of gravity. Monetary power rarely shifts through speeches or declarations. It shifts when the architecture itself changes, when countries quietly build systems they can operate independently. This structural shift is unfolding alongside growing concerns about the political environment surrounding U.S. monetary policy. In January 2026, multiple outlets, including CNBC and Motley Fool, confirmed that the U.S. Justice Department had opened an investigation involving Federal Reserve Chair Jerome Powell. At the same time, the administration made attempts to remove a Federal Reserve Board governor, an action considered extraordinary by historical standards. While officials emphasized that institutions remained intact, global investors pay close attention not just to policy decisions, but to perception. The credibility of the Federal Reserve rests on its independence from political pressure. When that independence appears challenged, especially with Jerome Powell's term set to end in May 2026, foreign governments and central banks begin reassessing risk. They don't need a crisis to act. They only need uncertainty. And in global finance, uncertainty is often enough to trigger lasting change. Jerome Powell's term as Federal Reserve Chair ends in May 2026, and speculation has intensified over who might replace him. And, more importantly, what that replacement would represent. The concern is not about personalities or politics in isolation, but about institutional independence. For global investors, the credibility of the Federal Reserve depends on the perception that monetary policy is insulated from short-term political influence. When that perception weakens, even subtly, risk premiums rise. Investors demand higher compensation for uncertainty, not because catastrophe is imminent, but because predictability has diminished. In global finance, confidence erodes long before crisis appears. This helps explain why foreign demand for U.S. Treasuries has softened. It has not collapsed. There has been no mass liquidation of U.S. dollar assets. Instead, what is visible in official data is a steady recalibration. Countries are reducing marginal exposure, not abandoning the system. They are increasing allocations to assets that are politically neutral, physically controllable, and universally recognized. This includes gold, regional currency reserves, and diversified settlement mechanisms. The behavior is cautious, incremental, and deliberate, exactly how sovereign institutions act when adjusting to long-term risk. This is where popular narratives often miss the point. This is not about the sudden demise of the US dollar. It is about a transition from a unipolar monetary system to a more multipolar one. In such systems, dominant currencies do not disappear. Their influence diffuses. Multiple centers of monetary gravity coexist, reducing dependence on any single issuer. History offers a clear parallel. The British pound did not vanish after World War II. It declined gradually over decades as the United States rose to economic prominence. Today, a similar process may be beginning, not because America is collapsing, but because global power is more evenly distributed than it was in 1945. Gold's role in this transition is not mystical or ideological. It is mathematical. Unlike fiat currency, gold is no one's liability. It carries no counterparty risk, no default risk, and no dependence on the policy decisions of any single government. It does not require trust in a central issuer or faith in political stability. That is precisely why, during periods of systemic uncertainty, not panic, not collapse, institutions return to it. Central banks do not buy gold because they expect the world to end. They buy it because it functions outside the system when the system itself is changing. The most important takeaway is this: markets are not pricing in apocalypse. They are pricing in transition. The signals are visible, but they are often misunderstood. The US dollar recently touched a 4-year low, recording its worst annual performance since 2017. At the same time, gold experienced its strongest monthly rally since the 1980s, driven by record physical demand exceeding 5,000 tons. NATO allies have begun repatriating gold reserves, while major Asian economies are building alternative vaulting and settlement systems. These moves are unfolding alongside growing political pressure on central bank independence across several countries. None of these developments, taken alone, signal collapse. Together, they form a coherent pattern, not a crisis, but a recalibration. History shows that monetary systems rarely break overnight. They evolve. And what we are witnessing now is the early architecture of a more multipolar financial order taking shape. And transitions favor preparation over prediction. History shows that monetary systems evolve not when they fail outright, but when trust becomes fragmented. The world does not need to abandon the US dollar for its dominance to weaken. It only needs alternatives that are credible, accessible, and increasingly used. That process is now visible, not in headlines, but in vaults, balance sheets, and quietly revised forecasts. The question is no longer whether the global financial system is changing. The evidence says it already is. The real question is whether we're paying attention.